Hey, good morning, everyone. Marty Missouri here. It's the 25th of October, 2023, with your midweek market update. It is currently 9 minutes past the opening bell. Stocks are struggling. The S&P is down 2/3%. The Nasdaq 100 is down 126 basis points, so 1.25%. Volatility is bid up. VIX is at 1943. Nasdaq 100 VIX at 23. So kind of a risk-off morning so far. This morning I'm going to discuss a couple of topics that I touched on the written blog on Monday and Tuesday of this week. We will get to some technicals. I want to look again at stocks, gold, yields, and the dollar. I think the relationship between these right now is fascinating relative to the trading, during this, call it bear market rally. That's what we're calling it over the last year, and how that's been shifting a little bit of late, and then to just kind of noodle on what may be going on under the surface that's inspiring some of this divergence that we're seeing. Again, what I will do, folks, for those of you who don't care for the technicals, I'll spend the first part talking at you about things that I think are really pertinent, and then the rest of us will hang on for that technical analysis, which I think is very important here of late, because that's where I really get into the weeds of these asset class relationships and correlations. So in front of you is the Monday blog post, and I title it "Not So Fast on That Bull Market Call," that new bull market call. And then, of course, readers, I update you every Monday on year-to-date and the last couple of years' results across sectors, regions, and asset classes. So what I say here is, if you've been tracking our weekly results, you've noticed the red shades are growing. And we've maintained since October 22 bottom in stocks, which we actually called right on the nose at the beginning of 2022. Macro dynamics have remained such that a next leg down carries odds too high to ignore. Now, many on Wall Street would tell you a new bull market has begun. And that's fine. I'm certainly okay with that. I'm looking forward to the next bull market. We will find one, no doubt. But I struggle with calling it yet, particularly when the equal weight index, the S&P equal weight, which gives equal measure to all of its components, is down 12% from July 31st of this year, and sits only 8% above that October of last year low, while still down 17% since January of 2022. If you find that uninspiring, look at small caps. The Russell 2000, which typically leads the way in new bull markets, and we will be buyers, make no mistake, when we believe it's the right time, it's still down 31% from the peak in January of 22. Now, granted, the cap-weighted index, the S&P 500, the headline index, still sits 18% above that October low. This is as of Monday. But nevertheless, it's 8% down from July, and it's still 12% down from the all-time high in January 2022. So suffice to say that if a new bull market has indeed begun, I suspect, in fact I know, that its first-year performance is the worst ever. Typically, that first year of a bull market is where you do really, really well. That's been our experience as an investor in equities. And other than the Magnificent 7, I'm going to get to those statistics here in a second, investors have not done very, very well. So it's every bit as, if not more likely, that what we're experiencing right here is still a bear market rally. So what explains the divergence between the equal and cap-weighted index? They're calling them the Magnificent 7. Jim Bianco updating those statistics. As of Friday, the correction from July is now at 8%, the largest since the bottom a year ago, largest correction, which was October. This correction is bigger than March, when the regional bank issue was freaking everybody out, when everybody was hyperventilating about bank failures, as he says. The S&P closed below its 200-day moving average. We'll look at that here in a second. For the first time in 154 days, technicians would say that's the primary trend, which is now down. What kind of year is this? Well, the S&P 500 is up 10% for the year, but take out the Magnificent 7, and the S&P is in the negative on the year. believe it or not, 7 stocks. So the S&P 493 is down. Now, add large, mid, and small cap together, and you get the Russell 3000 index. This is kind of mind-blowing. Take out 7, the other 2,993 as a group are down on the year. Remarkable. I'm certain that we haven't had that kind of concentration since 1999, if ever, and that's not the right analog for the bulls, to put it mildly. Last year was a 25% bear market. The belief is it ended on October 12th of last year. A year later, the market cannot rally, save for 7 stocks. It is yet to make a new high, which, and I agree with Jim, that would be, if you wanted to define a new bull market, that would be it, not 20% off the bottom. This looks more like a bear market correction. Obviously, we're in that same camp. So anyway, again, folks, take out literally a handful of stocks, and let's just put 2 initials on those, and that would be AI, that AI craze after NVIDIA basically got that ball rolling, and all CEOs had to do was mention AI. Well, it's not working so well for Google, and I shared a week or so ago excerpts from a Wall Street Journal expose on the fact that AI right now is really just expensive, and I think it's a big deal long term, but it's not a profit engine. In fact, the opposite so far. So that's a big risk to this market as well, is if these companies come out and announce and say, hey, you know, this is taking longer, it's costing more, we're going to have to up our prices, yada, yada. It may not be welcomed so well, given the big oomph that it gave these stocks from late last spring, whenever that was, up until July. And I think with the recent correction, you've pretty much taken those gains back. Okay, so the other one I wanted to share was yesterday's blog post. I called it Beyond the Time Being. So long-term treasuries actually rallied on Monday, seemingly sparked by hedge fund guru Bill Ackman's assertion that the world is too risky to be short bonds. So he apparently played it pretty well. They were short the bond market. Bond market has been selling off. Well, they've covered those shorts, according to his tweet. Now, he tweeted at 6:45 a.m. Monday morning. So that TLT was actually opened down 1% or so. And then when Ackman's tweet came out, this is what happened immediately, right? Now this is the price going up, yields going down. So this is people freaking out and buying bonds all of a sudden. We ended up well over 1% on the day. Now, as for equities, I see decent odds of a near-term bounce, frankly, that'll capture or recapture some of the hit stocks have taken since July. I'm not saying certainty, I'm saying decent odds. Now, some argue for upside from here based on favorable seasonality. Q4 is pretty good, November, December in particular, and perhaps anticipating a strong retail season. That's not my take. My take is that a rally may happen if we get weak data. And in that instance, stocks will get bought as investors or traders seem to believe that it's all about the Fed, and that weak data will have them thinking that the Fed's going to ease up. Conversely, should the economy actually show real strength into year-end, I'm thinking that stocks may actually struggle, as such a scenario supports inflation fears, right? And the notion that monetary policy is not tight enough, which basically that's a quote of Jerome Powell last Friday. The move in bonds on Ackman's tweet, captured in the chart above, would also be the sort of knee-jerk reaction we can expect from a meaningfully weak data point. In a sense, Ackman wasn't a data point. He's not always right, make no mistake, but it was fear that somebody's going to be buying this stuff, that the economy is going to be weak and so forth. I layered on the NASDAQ 100, literally popped right at the same time. So I think that supports the notion that bad economic news is good news for the time being. Now, beyond the time being, folks, make no mistake, bad economic news is bad equity market news, because bad economic news, to the extent that it means we are going to have a recession, stocks are not priced for recession. They simply are not. And you can see here, we actually programmed in a ratio of the leading economic indicators to coincident economic indicators, and that's what this line is here. We've never been at this level without either being in recession or approaching recession. Okay, it could be a first. I'm open-minded to anything. Now, this is S&P earnings, right? So this is earnings, beginning to buckle a little bit, but you can see what they do during recessions, right? And they do this, and make no mistake, the Fed will be easing, and this happens in a big way, despite what they might say about their fight against inflation. Stock market will force them to ease, I think. But if it's induced by a recession, typically they're cutting and stocks are still falling. Now, we do want to be positioned to take advantage of those cheaper prices, if indeed they come, before the recession's over. The market tends to bottom, halfway through the recession. Our indicators will essentially give us a clue that the worst is over. And that's probably when everybody's going to be freaking out. And that's probably when we want to begin scaling in to our best ideas for the next bull market. But folks, my same message over and over and over again. Oh my, you want to be patient right here. And non-client viewers, if you work with other advisors, you do this yourself. I'm not making investment recommendations here. If you're bullish, maybe you should be buying right here. If you're bearish, talk to whoever you work with about how they are hedging you against something precarious, something dangerous to the downside. The best way and most efficiently, if you know how to use options. And we basically do a calculation for our clients that measures volatility relative to the S&P. We decide how much downside volatility we're willing to take, and then we buy, right now, S&P 500 put options, and we manage those quite actively. That worked beautifully during the COVID situation, and at certain times when we've had certain breaks in the market, they've provided us some pretty good relative performance. That was the case last week when the market was down over 2.5%. We were down less than 1%. This morning, as the market's selling off, we're just barely down. As I speak right now, the S&P is down almost 1%. The NASDAQ is now down 138 basis points. And I'll just share with you that right now our core portfolio is down 21 basis points. What's working this morning for us is uranium miners are up pretty nicely. That's a very small position. Gold is not a small position, and that's up 68 basis points. We have a natural gas stock. Other things that are up, Mexico equities are up, silver's up 1/4 point. Energy stocks are actually up this morning. Staples, which is not a small position for us, consumer staples ETF, is actually, call it 4 basis points up. So we have enough things that are doing relatively well this morning. That's not a commercial, non-clients. I'm just trying to bring value here and giving you some things to think about. I'm not telling people they should be bearish. This is really designed to speak to clients about what we're doing within portfolios. But we do think there's going to be an opportunity, and it could occur over the next few months, to get bullish once again. Right now, our indicators aren't giving us that signal. Let me say it just one more time. This is a disclaimer, not advice. Past performance is not always indicative of future performance. We are not arrogant. We're not bragging about anything. Believe me, having done this for 39 years, we are humble. Believe me. So this is just, by our estimation, a time to kind of be on your toes, be tactical, maybe be defensive. So folks, those of you who are not interested in the technical analyses that I do on these videos, thank you so much for watching and listening. And there'll be an economic update for you at the end of the week. And for the rest of us here, let's take a look quickly at the S&P 500 daily chart. Remember last couple times ago, we painted this bear flag, and boy, this is really playing out so far, right? The length of the flagpole becomes your target. Let me move that here. And that takes us right down to 4,100 on the S&P. Remember last time I pointed to 4,200 and I said I will be surprised if that doesn't serve as support, that we may get a bounce off of that for at least a few days. Well, we got it for 2, and this morning right now the S&P is doing its darndest to go below that. We're at 4210 right now. So again, still bouncing off of that. Once we break that, there's not much support between here and 4100. Remember what I said that right here. There really wasn't anything keeping us from 4200, and sure enough, a day or two later, we were there. And through the 200-day moving average, that's not a good sign. We did close above it yesterday, but we're down back below it this morning. The day is still very, very young. The momentum indicators are not encouraging. I will say this, though. If we were to bounce right here and this flips up, we're going to have some very compelling short-term bullish divergences, which would suggest there could be some steam ahead. It could be a good November, December, but I think we're going to need weaker economic data, and that's not what the market is seeing. In fact, bonds are selling off pretty aggressively today, I think on prospects of things like a strong GDP number for the third quarter tomorrow, and I bet we get that, so we'll see how that plays out. The NASDAQ 100 ETF that we track, as you can see here, again, I said this, there's not really anything keeping us from 350. Almost got there. Market bounced up against that pretty aggressively for a couple of days, fighting resistance at 360. Bouncing around here. Swing trader might have a good time on that 10-point move if we continue to bounce around there. So, pretty much the same look, maybe a little better look technically than the S&P because we're still above an upward sloping 200-day moving average. On the Qs, I do think the risk is in the Qs. That's where those Magnificent 7 stocks are featured. They are in the S&P as well, just more concentration there. So remember last time we looked at the 10-year yield and we were sitting up here and I said, the narrative is, I told you about a bond expert who I listened to that morning who said it's going higher, and I said, yeah, but the technicals say it's going lower. Sure enough, we rolled over right in this upward sloping wedge, bouncing off of the uptrend line here. That's a big jump in yields this morning. It's corresponding with a big drop in stocks as I speak at you so far. Remember I said here, if we get that decline in yields, it's probably going to be pretty bullish for stocks. That's exactly what we experienced right in here. That was a big day, big update for the markets. And then here we are going up, back in yields, stocks going down. I do think that yields will break at some point because I'm bearish on the economy, and I mean break lower. We're actually adding to our long-term treasury exposure now in our core portfolio. So gold, I know some of you are interested, very interested in gold. And this is GLD, by the way, the gold ETF, which we actually use in our portfolio. So pushing again this morning up against this resistance level. Gold looks pretty interesting technically. Getting a little overbought right here. But you break through this level and up through here, and suddenly you're going to have technicians really talk about a potential for a pretty strong move to the upside. I'm a little agnostic right here on gold. It's interesting, as I said last time, how it's trading, right? In fact, let's go ahead and jump to that. So this top panel here is gold in white, the 10-year treasury yield in blue, negatively correlated, trading on different things, and then here lately, they're both moving in the same direction, happening again this morning. Yields are up. Gold is up. Okay, so gold's been trading, I think, largely on the prospects for real yield. That's nominal yields minus inflation. You have negative real interest rates, meaning inflation running hotter than the nominal yield, and you've got the recipe for a strong upward move in gold. And I've written about this extensively over the last couple of years. I actually think that that is going to have to be the future, given the current federal debt to GDP in the U.S. is very reminiscent of the 1940s. Frankly, we need inflation right here. And we need inflation to run hotter than interest rates to essentially deflate the dollar enough to inflate away the national debt. Oh, I'm sure we'll get into those very deep macro weeds more in the future, but that's still our base case going forward. And by the way, that's an investment-rich world that I'm describing there. But we're going to be investing in things that do well in a weaker dollar environment on a long-term trend basis. I'm not necessarily a dollar bear on an intermediate term basis, although I'm going to close here with the dollar chart that says that there's some potential weakness coming. So anyway, interesting dynamic. Is gold reacting to Middle East tensions. That seems to be the headline excuse. It could also very well be that the gold market is actually sniffing out what the bond market will be experiencing, and that is weakening data, yields coming back down as the bond market responds to that weak data, but the underlying inflation dynamic being stubborn. That's actually what would really inspire an upward move in the gold. But it could be geopolitical fear as well. It seems that central banks are very interested in adding gold to their reserves, and that could be upward pressure on price as well. Maybe people are saying that bonds are precarious because there's going to be so much issuance going forward that's going to push yields higher. Therefore, gold is the only legitimate safe haven out there. I mean, it can go on and on and on, and it could be a combination of forces as well. But definitely something we will watch. I think that we will have a really good handle in the not too distant future on exactly what is motivating the price in gold. And it really depends on, does it continue from here, or are we about to sell off? It has really been a good thing for us in our core portfolio of late, but we own it, quite frankly, more with the longer term in mind right here. Okay, and then lastly, the dollar. This is interesting. The dollar is actually up 23 basis points today. Could be more given how high yields are popped here, or how bad bonds are performing this morning. But folks, technically, this is not a good look on the daily for the dollar. You can see we've got some pretty good support that we've established right here, but we have momentum, dying off quite significantly, or we had up until today. Now, if the dollar tanks, and you look at correlations, right, could be very good for stocks the way the market's been trading of late. Ultimately, if the dollar gives way because of declining yield differentials between the dollar and competing currencies, well, that lower interest rate regime would be amid falling economic activity, amid falling corporate profits, right? So that's the scenario where the dollar would not be bullish for stocks. And so suffice to say that we've got very interesting dynamics across asset classes that are really sending mixed signals. But let's just go back to the beginning of my presentation. When you look at the lack of breadth in this market, this is anything but a healthy setup for the equity market. And we may very well get a nice 2-month bounce from here. I'm not at all rejecting that notion, particularly if we're looking at a weaker dollar right here. But there are so many factors in play. If indeed the economy is going to show strength, and when looking through the earnings reports, yeah, I could point to the ones that say, all hell's about to break loose. But those are still in the minority. For the most part, companies are still, they're recognizing some stress in some pockets, but generally they're giving a pretty rosy outlook from what I've read on the economy going forward. Now, that is at odds with what we're reading in the consumer surveys, and it's at odds with what we're reading in the small business survey. But when you look at things like the PMIs that came out this week, JP Morgan's version, it actually improved in the manufacturing space. So a lot of mixed signals. Just keep an open mind. We will try not to filter market dynamics through what you want to happen or how you're positioned in your portfolio. Most of you are clients who are watching this, but those of you who aren't, just essentially take a deep breath, be willing to entertain all possibilities, and do your darndest all the time to even develop your own argument for how you could be wrong. Don't just look for bias confirming data. That's what everybody does. The talking heads on your CNBCs and so forth, they're just talking their book for the most part. And I'm sure there's some good ones who don't do that, but my observation over the years when I used to watch that stuff was that, wow, you know how they're positioned. They're pushing back against narratives that conflict with theirs instead of entertaining them and saying, hey, yeah, I need to explore that possibility because that conflicts with what I'm saying. So anyway, that's what good investors do. That's what good advisors do on behalf of their clients. And folks, I will leave it there. Thank you so much, as always, for watching and listening. Tomorrow morning, there'll be something on the written blog, and then Friday, we'll get into the video analysis on the markets and then on the economy. Have a great day. Take care. Bye-bye.